Welcome to another episode of Real Estate Investing Explained. Here's today's question. Everything you've talked about so far, syndications sound great, but what are some of the downsides to a real estate syndication?
I'm super upfront about these, and because I think it's about strategy matching. So many folks love to have what's the best investment battle? Is it flipping? Is it wholesaling? Is it multifamily syndications? Is it, let's compete against asset classes? Is it self-storage? Is it mobile home parks? It all comes down to strategy. And the strategy for you will be very different than for me, Robert. So for us, we are interested in generating a certain dollar amount of monthly, quarterly cash flow. And that just means mailbox money. And so for that, syndications is a great fit because we want to be fully passive. By the time that our kids are a little older, we want to be fully passive so we can go travel the world, take them on some trips, maybe even live abroad and not have to worry about working full time. So that is not a good fit in terms of syndication investing for an investor who really likes to be hands-on. A bunch of folks, that reach out to us to potentially join our club, a certain profile of folks in that group, they might come from a background of being really hands-on handy, like former GCs, like general contractors, folks who are architects. People who really love to be involved will not have a great time or experience in a syndication that's totally passive because they like being in the guts of how these things work. Like they want to be active. They don't want to be passive. So I actually don't think that that's a great fit. If someone wants to go and be part of a syndication, they probably want to actually just go buy a rental property and do it themselves. If it's like a rehab or a flip or a BRRRR, if you're familiar with the BRRRR strategy, that's a really good fit for someone who wants to be more active and nerd out on it operationally. Another downside, I would say, is that you're putting your trust into another person. And I feel really good about vetting that type of stuff because I have 13 years of large and small high velocity team building. I have interviewed hundreds of people. I have hired hundreds of people. I'm pretty darn good and very experienced at vetting people across the table from me. And if you are not experienced in doing that stuff, you really got to be careful with jumping into deals and syndications with other people that unless you feel like you've really got a good understanding of their experience level. And the example I will give you in terms of our vetting criteria that we use is this notion when we're vetting their track record. There's 5 big buckets of things that we vet. We look at their track record, we look at their values, we look at their approach, we look at their team, and we look at their communications. And so within those buckets, there's actually a spreadsheet that has a ton of questions, over 50 questions that comprise this framework just to vet the sponsor. And so going into that, we look for this thing called failure response. And I will literally ask one of the sponsors that we invest with, tell me about a time that you got figuratively kicked in the teeth. As an entrepreneur, what was the time that things didn't go the way that you wanted them to? And I want to hear, how did you get through it? And what did you learn? I bring that up for the question around downsides, Robert, because I think people don't realize how critical it is that they vet how that sponsor responds. Because markets rise, markets fall. We know it's very likely, particularly in a time like right now, with a potential black swan event going on right now with the coronavirus stuff, we don't know which way it's going to go. But what matters is that the capital we have put in to a bunch of these syndications is going to be responsibly managed. And the decisioning under duress, if you want to call it that, from the sponsor is going to be sound. And it's not going to be emotional. And it'll be something that they're able to keep their hand firmly on the wheel and just make good, sound judgments unemotionally. Probably last but not least, for downsides, I would just say it is so critical as you're putting your capital into an investment. Sometimes we'll get a question from an investor that says something like, well, I'm glad we've talked about this, Spencer, and this sounds like it's something we do want to invest with alongside you. So is that 8% return guaranteed? And if I get a question like that, I immediately get very worried that the person hasn't necessarily been listening because this is not a savings account. It's not a high yield savings account, right? You can lose all your capital. It's total capital loss is very much a possibility. And it's so important that people understand that. So you could lose on your money. I call that a downside.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.